Hi, good morning. I am Satya Prasad and I born and brought up in Hyderabad. So, coming to my education, I completed my computer science and engineering from Satyabama University, Chennai in the year 2022. Coming to my strengths, I am uh, coming to my strengths. One of the most important skill that I have is communication skills, ability to communicate. And second thing is analytical, which is analyzing data and getting into a conclusion on the data and what actions we can take and what are the analysis of the data. And the third thing is thinking everything in a fundamental way, like knowing the what is the main reason behind what the problem, and what are the most important fundamental variables that we can control. Those are some of my strengths. Coming to my hobbies, I like playing games like volleyball, and I used to read lot of books daily, mostly non-fiction kind of books. And I'm also daily newspaper reader, so I will regularly follow news by reading newspapers like Business Line and Business Standard. So this is my basic introduction about me. Coming to my second question, that why did I choose investment banking? So as a person from a non-finance background, from a engineering background, I felt very fascinated, and not knowing anything has made me more curious about to know about the finance field, not regarding. So it all started when I'm in the college. I used to know the stock market and everything. So I want to know how to make an investment. That's where my journey has started. So to learn myself, I thought I should make with the help of Google and YouTube. So I came across a lot of things in finance, like like balance sheet, how to analyze balance sheets, those things, and I've enjoyed doing it. So I thought I should make something. I should explore this career more. And so later I came across this SIBA program, and where they're providing me an opportunity to get into an investment bank where I can put all of the skills that I've learned in this theoretical part into a practical use. So that's why that I choose an IB. Coming to my topic today I'm going to talk about what are fixed income securities and types of fixed income securities, what are the features and the risks and advantages of fixed income securities. So first of all, what is a fixed income security? Fixed income security is nothing but a kind of a loan that that we as investors give to the company, and in return, the company is going to pay us an interest, and every year the company will pay us interest, and at the end of the period, the company is going to return back our principal amount that we have given a loan. So if I want to give an example, let's take there is a company called as Reliance. Reliance wants to expand its plant or build a new plant. So for that they need capital. So they approached the capital markets with the help of investment bank, and they have decided that bond is best because they have good credit rating and everything, so they can rise at a cheaper rate. So they approached and they thought they should raise $100 million worth of capital. Now the Reliance industry is going to issue securities like a paper, with each denomination like 1,000 rupees bond, for 100 million worth of bonds. So the investment bank will sell those bonds to the investors, and investors in return takes the security and gives 1,000 rupees to the company. And each year, the company will say on the bond itself, the company will say each year we are going to pay 5% or 6% interest on the bond, and that is called as coupon amount. And there will be a tenure of the bond. The tenure of the bond will be, let's take 10 years. Each year, let's take now today time is zero. Now we have given 1,000 rupees to the company, and at the end of 1 year the company is going to pay interest like 5%. 5% means 50 rupees each year. So this is how the company cash flows will be. So the main purpose is to get a regular stream of income with a fixed kind of with predictability. Mostly that is the thing. So coming to the futures of the bond. So here are some of the basic features. First is it has fixed interest payments. The payments that we can get from a bond is already decided when the bond is issued itself. That is the interest amount that we get and the principal that we get at the end of the period. So it provides a stable income for us that we can able to know at what period we are going to get get our interest, and at what period we can get our money back, so that we can use that money to finance other things in our life. And the second is maturity date. So it has a fixed maturity date that is mentioned on the bond when it is issued. So there will be bonds like 1 year bond, 10 year bond, 30 year bond, 40 year bond also. So the date when the bond will get matured is already mentioned. So we can able to clearly predict at what date we can get our capital back. And the third is issuers. Issuers can be governments, corporates, and municipalities, and also these are the main issuers. And also some municipal bonds are nothing but state government bonds. The state governments issuing those bonds. For last one is credit rating. A credit rating is nothing but the issuer of the securities, like a company like Reliance company, has to get its bond credit rated. Credit rating is nothing but the credit worthiness of the company, like how probable or how likely the company is going to return, is going to pay us interest and going to return our capital back as they have said. So, is there any probability there will be rating agency like S&P and the Moody's? So they're going to give different kind of ratings to different companies based on their character and what is the business they are in, based on the financials. Based on that, they will give. If the credit rating is good, the company can issue at lower price, and also for investor, he can expect that his money will get back with more probability that there might not be any default. That is what credit rating is. And there are different type of bonds, and the first one is government bonds. Government bonds is nothing but governments issuing the securities to raise capital from the public. And similarly, government is going to, as you know, government bonds are most secured bonds, because governments are the governments can have power that they can print new notes in case the government has not have that much income to pay off the bonds. What they can do is they can simply print the money from the central bank, and they can simply distribute money to the bondholders. So that's why there is a very low probability that government will default. It's zero probability. And the second is corporate bonds. Corporate bonds is nothing but corporations like private companies like Reliance, HDFC Bank issuing bonds to the public for capital purposes. And the third one is municipal bonds issued by local governments like Telangana government, AP government. Those bonds issued by state governments are called as municipal bonds. And the third one is mortgage-backed securities. Mortgage-backed security is nothing but converting an illiquid asset. First of all, it is called as securitization. Securitization is nothing but converting an illiquid asset that is cash flow producing into an liquid asset. So what it means is, let's take there is a home loan. Home loan is a well secured investment, because the in case the person who has taken the loan cannot pay off, they can simply take the loan, and they can sell off and get the money back. It is called a secured investment. But what happens is, today you are going to give the loan, but the time that you're going to get your money back is long period, because most of the home loan is very high ticket, and the size of the tenure of the loan will be minimum 20 or 30 years. What is happening is, if I were a bank, I am giving loan to the this person, but what happening is, it's taking all of my capital in the single investment, and I need to wait another 20 30 years. So that what happening is, my business is not expanding that well. So this is from this side. So if so what these banks will do is, they will create a special company called a special purpose vehicle, and it is nothing more than a shell company. And the whole job of the company is to so what they will do is, uh, after creating this shell company, the company will create some securities backed by these mortgages. They simply ship they will collect lot of these similar kind of loans into single pool, and they will take this single pool into the this new company. And what they will do is they will issue securities backed by these loans. Like, let's say, for example, let's take, you have pooled 100 home loans. Like, there are people, like there are the job holders who are software employees and who have good credit rating like 850. What they will do is they will take 100 people together, 100 kind of loans together, loan documents together, and they will sell off to the special purpose vehicle. And what the special purpose vehicle will do is the special purpose will vehicle issue 100 kind of securities. Like, let's say 100 securities are issued. So what happening is, in case the securities has been sold to the investor also. Yeah. So this is big concept. I think I will say it in next slide. So these are some of the advantages. First one is stable income. As you know, the interest payments that we will be able to know how will be the cash flows of our bonds based on the coupon amount. We will not get less than the coupon amount, and also not more than the coupon amount. So we will get regular interest payments. And the second one is capital preservation. So the company is not going to totally use take away our capital. So at the end of the maturity, the company has to give us the capital back. The third one is diversification. Fourth one is liquidity. As you know, these bonds can be traded in the secondary market by selling it off based on market conditions. So here are some of the risks in these bonds. First is interest rate risk. Like, let's take, you bought a bond which is paying 5% interest, but in the market, if the similar kind of bond with similar risk is paying more than 5%, like 7% return. In that case, what happening is you have locked in 5% returning bond with you, but you can get it at 7%. The 2% you are losing, right? So if you want to sell the bond to another person, the another investor will say, why should I have to pay you why should I have to pay you the value of the bond which is paying similar 7%, because I'm only getting 5%. Why should I have to pay you? Then the bondholder of this 5% coupon amount has to sell the bond less than the value what is the market price. So it is one of the risk. Second is credit risk. The risk is that the issuing company or issuing security issuer might default on the payment that he has obligated to, like interest payments and the principal amount. In case the company get bankrupted, the bondholders can face huge losses. And the third is inflation risk. Like, as I said, there is a bond which is paying 5%, but the inflation rate is more than 5%, like 6%. In that case, if you can earn also 5%, the value of your investment is going to get depreciated, because the prices are increasing more than 6. If it is increasing 6%, if you have money that is increasing only 5%, you can't able to buy the prices, right? If you take there is a phone which costs 10,000, but it is increasing at 6%, then it is 10,600, but you have only 10,500 with you, then you are losing your money. That's what it means. And third one is yield measures. Yield measure is nothing but if you take the all the interest amount that you're going to get and divide it by the current market price, the percent into 100, you will get a percentage called as current yield. And the third one is yield to maturity. Yield to this maturity is nothing but the return that you can get if you buy it at the current market price and hold it till it's get maturity. The return that you can get is called as yield to maturity. And there are two concepts. One is dirty price. Dirty price is nothing but, let's say there is a bond which is as you know, bond will only pay interest at the end of each year. But after each year, the period between this year and the next upcoming year, when the company is paying dividend, in the time period, you are earning some kind of interest, right? Let's take there is 5%, but in between, you are getting some kind of, because this period also you are getting that interest. So that is called as accrued interest, but interest is not yet paid. That is why it is called as accrued interest. So the price, let's take it is 6 months, and in 6 months, if it has annually, it is paying 5%. It is 6 months. If you divide it by two, It is nothing but 2.5%. So in 6 months you have already earned 2.5% of the return. That is called as dirty price. And the clean price is without this dirty price is called as clean price. Like let's take the bond price will be the last period the company has paid. That is where if that is calculated, then it is clean price. So that's all, guys. Yeah, any questions you can ask. Yeah, Atik, Vamshi, and Mahesh.
No, bro.
Questions, Mahesh Babu.
No questions.
Oh, then you understood everything, yeah. Understood.
Yes. Yes, yes.
So, do you want me to ask a question?
Yeah.
So, as I told that there are some kind of risk associated with fixed income securities, like these risks. Can you tell me about what is interest rate risk?
When price will fluctuation, that interest rate will be changes, no?
How?
When price will up or down,
How? Can you give me example? I didn't understood what you said.
if when a rate changes, like prices will up and down now, that time interest rate will be changes.
Mm, okay, so what you are saying is when bond prices changes, the interest rate in the market will change. That's what, is that what you are saying?
Yes.
Okay. Yeah, I think that's not what I've said. But what is interest rate risk is if you bought a bond which is paying 5%, but in the current market scenario with similar bond with similar risk is paying 7%, then you are losing this 2%, right? Because you could have bought at 7% interest, but you bought it at 5% because you bought it previously. So you are losing the 2%. That is what interest rate risk is. Because of that, if you want to sell the bond in the market also, you need to sell at a
So
less
like
price than the
seven.
face value.
Yeah.
Yeah.
Yes.
Yeah, I think any questions? I think you have questions.
Hello, Prasad.
Yeah, yeah.
So, related to maturity, can
Hmm.
you explain? So,
Yeah, yield to maturity is also called as internal rate of return of bond, IRR of the bond. So, if I want to say, let's take so simply, I'm going to explain a simple calculation of a bond. So, how bond prices are, it's a big topic. So, it is nothing but I need to explain on the board, but I will give you how it is calculated. I should have it can only be explained when it can be only explained in the paper, but I will give you a brief overview of what YTM is. Let's take there is a bond with a face value 1000 rupees, and it has 10 years of maturity now, and the interest rate, the coupon amount that it is going to pay each year is 5%. But uh, but in the market case, the price of the bond is the no no the in current market case, the similar bonds are trading at 7%. So if you are an investor, what you will do is, why should I have to pay a face value amount if I can get 7% return, right? So if you want to buy, if you are looking into buying a bond, then you will mostly prefer the 7% bond. So what happens is in that case, getting louder. Yeah. So YTM is nothing but the rate of return. Like if you bought a bond at current market price, and you hold till at the end of the year till the maturity, the return that you can get by holding this bond till whole period is called as YTM. the rate of return. uh, it is calculated in percentage, so it is nothing but the rate that you can expect uh, if you're buying now and holding till end of the period. The rate that you can get by investing in the bond is called as YTM.
Okay. Got it.
What?
Attorney.
Yeah, so you asked me that YTM. I will definitely explain you how YTM is calculated in the class today. Yeah. So okay guys, thank you.